The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Larry Pesavento.
Okay, good afternoon, folks. And I put the chart of the VIX index up here because I think Friday's action really told what was happening. I really enjoyed Basil's description of what he was saying. It was pretty much spot on with what I was saying. As a matter of fact, I was in even more awe of it on Friday because I don't trade the VIX very often, maybe 2 or 3 times a year, but I do watch it because it's a pretty good indicator of, the sentiment of what's going on in the market. And the Dow was down 350 points when I checked, and I looked at the VIX, and it couldn't even take out Wednesday's high. I mean, I couldn't believe that. My little grandson, who's 4 years old, I tease him a lot, and he teases me. And when he says something, he always says, "Are you joking me?" And I looked at that, and that's the first reaction that came to my mind was, "Are you joking me?" I said, "This isn't very bearish to stocks." I said, "If the VIX can't do any more than this," and then it closed, right at the low end of the range, which made it a shooting star candle, which is one of the more bearish candles, which means that stocks probably want to go higher. So that's the thing. But at the same time this was happening, early in the morning, we had a really large pattern complete that is rather important, and that is the New York Stock Exchange Index left an island reversal. And, of course, the reaction was actually 382 of the low that we made back on April the 6th. And then, of course, today, with the market being pretty strong, that New York Stock Exchange Index has gained back just about all of its gains. Let's just double check it here to see where we are. Yeah, we're into the gap area. We've actually, there's no longer an island there because we have come down and we have filled that gap, which means that that island reversal pattern is no longer valid. If it were good, this market would have opened lower and continued lower. So that's what we're keeping an eye on this very, very closely. I'm hoping to have our friend Bill Ehrman on from Ehrmanometry next Monday because we have a situation where that's one of his key dates, I believe, sometime in April. He was looking at whether he has the time or not. I'll have to, try to work that out. But he's been pretty spot on at watching what this market's going to do. I've been following this market ever since 1959 when I put my first trade on an elastic stop nut. And I've seen just about everything through the years. I've watched all different kinds of methodologies and systems, and I have hundreds and hundreds of systems that I've had over the years in my library and stuff. But frankly, I've never seen anybody do anything better on the longer term than what Bill Ehrman has done. There's only been 2 people, a gentleman in London who happens to be one of my students and a good friend of mine, and then also Bill Ehrman. So these are based on the normal geometry of the markets, of which Fibonacci and pi and all these things are related to it. So we want to watch what's happening here in April. If you remember, we had Norm Winsky on last week, and he was saying we should have a top in here on Friday. We did. We broke 450 points from the high on the Dow. And now we're bouncing back a little bit. Whether this is just a 2 or 3 day rally, we'll have to wait and see. But that VIX index, you got to keep an eye on that. I think Basil Chapman is the master of it. So watch it very, very closely because it certainly gives you some indication of whether the market is, in any type of fear mechanism, which in fact we are not. We need to get that VIX above 15 before any fear will come in. I believe the fear is coming, but frankly, I think the fear will happen in the credit markets. That's where I think the real problem is going to lie, is in the credit markets, mainly starting out with junk bonds and then corporates and then munis and, down the line. So that's what my assumption is going to be. The Fed has been, pumping the goose ever since '09, and especially since 2011. And the pauper has to be paid at some time, and I think we're getting closer. Very, very close to doing this when we do it. Now, when we came down Friday, we stopped within a hair's breadth of the 61% retracement of the E-mini S&P and also the S&P cash with just within a heartbeat. And we'll put this up here and we'll take a look at it so you can take a look at it, because it looked really bad for the day. But as Basil was mentioning here, you got to wait till these bars complete, because they didn't close right on the low of the day like it should have. It made a 61% retracement from the low back in on March 24th, and we still haven't even taken out the low of March 11th. That March 11th low, when we take that out, boys and girls, the fat lady is not only going to be singing, she's going to be dancing. And that's going to be a very, very interesting pattern when it does complete. This is the pattern that happened to me in 1974. I was extremely long everything into 1974 and in July, and the market had turned down, and I didn't recognize the importance of that turn down until I blew everything out in October of 1974, which was actually one of the best things that's ever happened to me, because it forced me to study, for a year and a half. And that's when I really got into the Gartlys and butterflies. I didn't get into butterflies till 1988 with Bryce Gilmore, but the Gartlys and the ABCDs really became very, very important to me at that time, and I quit following any type of fundamental analysis. But one thing we've got to keep in mind here, and that is the mental part of this game that we're doing. All of our frustrations in this business, whether it's any business, whether it's your spouse, your children, your job, your priest, your rabbi, whatever it happens to be, all of your frustrations come from expectations that are unfulfilled. Now, I'm looking for a top sometime in this next 5-day time period, probably starting on next Monday. I'd love to see a big, strong up move on Monday, making new highs in all the indices. That's what I'm expecting. That's what I'm hoping for. But if that doesn't happen, I have to adjust my thinking, because I don't want to be lulled into the wrong side of the market. And if this market is strong all next week after the 28th, then there's something probably, seriously wrong here with my analysis, and I would have to readjust that. And that's one of the things, I try to do. There's no mistake in being wrong. The mistake is in staying wrong. And that's the whole key to what we're doing. That quote, no mistake in being wrong, the mistake is in staying wrong, is from Roy Longstreet and his son Bill. They live by that creed, and they're certainly correct on that. I mean, we make mistakes all the time. Everybody makes mistakes in the markets, whether it's, Tom O'Brien, Steve Rhodes, Daryl Martin, doesn't make any difference. Basil Chapman, however, Basil doesn't make too many mistakes, but these are the things that you got to be aware of, is when you're wrong, you've got to recognize it, very, very much. I know most of you folks are golf fans, because a lot of folks in Florida we have as listeners here, and if you watch Tiger in the Masters, I think he played one of his greatest rounds he's ever played, considering he hasn't played much competitive golf over the past year. And to finish 6 under in the Masters, it was really spectacular. Any other year, he probably would have finished in the top 3, but with the scores that they were having, it was, down quite a bit. But I think he did a fabulous job, and he's back. He's just, all he has to do now is to put his competitive head back together, just like we have in trading. You got to be trading in the zone. And once he gets his head in the zone, look out, because he's still young, he's still strong, and I think he'll do very well out in the future. Hopefully he'll get his personal life together, and because he's brought a lot to the sport. There's no question about it. All these young golfers, they're in that game because of Tiger Woods. And we owe him a lot. And I don't even like golf, folks. I have a 2 handicap, driving and putting. And the hardest hole I have is the one that has that clown with the windmill. I can never get my card up on that hole, and that causes me to bogey it several times. Anyway, the other thing that is important in the stock market, besides this island reversal and stuff that we've had in the market, is the fact that the IBB has held up extremely well during this down move. It's here again, it also stopped right at the 61% retracement of this last move. It's continuing to go higher. I wouldn't be surprised to see this one also make new high ground and everything. But when this market does turn, and I'm not sure exactly when it's going to turn, it is going to be worse than 2008. This will not just be a 2-year bear market. It'll be somewhere between a 3, 5, or 8-year bear market, and it's going to be pretty significant in my opinion. But maybe I'm wrong. We'll have to wait and see. But we'll just keep an eye on what's going to happen. Well, the one thing that will happen, and I really believe this, is that when it does top, it's going to tell you. You're going to see, much like a gap down like we did on Friday, but instead of the market closing, up in the upper 35 or 40% of the range, it's going to close right on its keister, and then it's going to gap down the next day. And then when you start seeing it gapping down with wide ranges, that's when you want to be really, really careful. It's been very difficult to be bearish this market since February, and especially in March, when we came down to that March 11th date, which was the 618 of all those numbers, the 382 on the NASDAQ, 618 on the Dow, 618 on the NYSE, 618 on the S&P. I mean, that tells you how important that cycle was. And it is really, really very important, because if we break that out, that tells us that that cycle low is over, and the cycle lows will be coming in, in the future, but they're going to be pulling the market down. So the March 11th is the key from my point of view, looking at Fibonacci and cycles and astrology and all the other stuff. We had a Bradley date come in on the 6th. The market has pretty much held that, but it hasn't really done very much either. So we backed off 3 or 4%, which is pretty much nothing. So we want to keep an eye on that. The bond market has held up relatively well also. We've had some lower tops in here, but it really hasn't gone anywhere. The $64 question in bonds is if we're going to get a flight to quality or not. That's the whole key. And if we do that, then bonds could continue to go higher as people try to protect their assets and stuff like that. But the real problem, I believe, is in the credit markets. It's not in the stock markets. It's in the credit markets. And, we live on credit. So when that has the problems, that's when we're going to have a, real evaluation of, what we're looking at. I wanted to mention just a little bit about the Japanese market here, because, this Japanese market has been going straight up, but we have a pattern now where we've had a 3 drive to a top pattern and completed a lot of ABCDs over the past 6 or 7 months. So that's another one that appears to be having some consolidation up in this area or getting ready to turn down. So a lot of these things are pointing into this week, and we're going to be able to see, but just 5 more trading days, a week from today, is what we should be looking at, where we're looking. So we got to take a break here to pay a few bills. 877-924-6678.
Trade with confidence and clarity while using the software that thousands of institutional traders rely on to make the best and most accurate decisions. Choose from 1,000 equities, currencies, and futures instruments utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. John Logan hosted a special subscriber-only webinar in December, and you'll gain access to that archive as well, so you can learn exactly what the TAS Profile Scanner can do for you. Try this product out. No matter what you trade, the TAS Profile Scanner can help you make more informed trading decisions. There's no obligation to pay anything. Don't let this offer pass you by. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartlys, ABCs, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, we're back, folks, and we're going to take a look at gold and silver now. One of the things I do over the weekend is prepare my trades for the coming week, and I was watching gold and silver, and as you can see from the gold chart, we have a beautiful pennant formation. It's about as perfect as you can get, with lower highs and higher lows, coming to a fulcrum, which is what you'd like to see. And usually pennants are resolved to the direction of the overall trend, and as you can see with the gold market, we are certainly in a downtrend. We broke down this afternoon, actually, let's put it late last night. Gold actually rallied to 1209. It took out the previous week's high by 10 cents, if you can believe that. I was shocked when I actually saw it. My limit miner didn't even go off because it only hit it one time, and I was asleep when it hit it. But it hit the exact 618 at 1209 an ounce, and then just has broken $18 from that level. And it looks like we're heading down to the 1170 area in the gold market right now, which will take it down to the 61% retracement of this last move that we've just had. Now, what I'd like to do is to show you what silver has done, because silver is really a tip-off, I believe, to what's been going on in the gold market. And we did the same thing in silver, except that last night silver couldn't even rally 50% of the previous day's range, let alone take out the high of the week like what gold did. So this was telling you how weak silver is, and now silver started, to break down pretty badly. And I believe we're going to get down into that, probably that 1540 level one more time in silver. So we want to watch it very, very closely. The Gartly that we had form last week in silver only rallied about 50 cents, which is, a considerable amount of money, $2,500. But then, the market just kept drifting lower. And then on Friday, we closed relatively poorly. And then we're a little bit lower today. So these are the types of things that you want to keep an eye on. And I'm bullish long term in the silver, but the problem is that it doesn't want to go up. And so it's pretty hard to be bullish on something that doesn't go up. That's the key. If you remember the old, the famous orator, Will Rogers said, buy stocks that go up. And if they don't go up, don't buy them. So that's some good advice. It's almost like buy low, sell high. So we'll have to keep that in mind longer term. But we do have a chance still here in gold. We need to hold the first 1170 area. And then if we get below 1140, they're going to turn the lights out in gold. We'll probably be looking at triple-digit gold somewhere around 950. 950 an ounce, which is still 50% higher, than we were, many years ago back in 2008 when we were at 660 per ounce. So just watch it very, very closely. But it's not ready as of yet. There's a lot of things happening this month, towards the end of the month, astro-wise. So that might be the thing that gives gold its final bottom, and then we'll see. If it does move up, gold will tell you that it's ready to go. It's going to have a move of $40 or $50 up in one day. Hopefully it'll be accompanied by, hopefully is a terrible trading word, by the way. Surprisingly, it might happen with increased open interest and increased volume. And if we get that, then we know that there's game on and we have a chance for gold to go a lot higher. But right now, it certainly doesn't look this way. I'm recommending to anybody that'll listen to me is to buy some silver dollars, U.S. silver dollars from, anywhere from 1840, 1860, 1880s, especially the 1880s, because they don't have a great deal of, well, some of them do. They don't have the extensive numismatic value that some of the things under 1880s do. But the coins that were printed between 1880 and 1929 and 30 are really, they're just basically 1 ounce of gold. It's a 1 ounce bullion. It's recognized all over the world. You can buy those for under $20 now, and I certainly recommend you having those. I started buying those things when they were $1 a piece. I actually went to Las Vegas in 1964 and bought as many as I could because they were still using them in slot machines, and that trip paid for itself about 4 times over because I'd bought $1,000 worth, which was a lot of money to someone just out of college, and 3 of those coins more than paid for the whole trip because they had numismatic value far beyond, their silver value. So I recommend, buying some silver dollars, put them away because things are not right here with this debt stuff that we've got going on, and there's some problems somewhere. We're starting to see little bits and pieces of it, but not a great deal yet. What'll happen is it'll probably happen in one tsunami, and we'll see what's happening. Okay, we still got stocks very strong, gold under some pressure, and bonds selling off a bit, so we'll be right back after these words. 877-927-6648.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 8 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com, educating investors. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, folks, we were talking about gold and silver, and I might mention that that's how I got interested in this whole business of finance. Was in graduate school. My professor in statistics, Dr. Jim Noblet, was a very avid speculator. He was really a very good trader, and he got me interested in this later. But in the class, he talked about Gresham's Law, where good money drives out bad. Where bad money drives out good. And this is what was happening, is the fact that we had a situation in silver where the silver dollar was, silver was being taken off the market because they were redeeming silver certificates that had $1 worth of silver value. And if you turned those in, you could get that many ounces of silver, and silver was $1.27, and so you're making 27% on your money. That was back in 1964, and silver went from $1.27 all the way up to $3.50 over the next couple of years. So those $1 silver certificates were worth $3.50. And so if you had those, all you had to do was take them to the mint, and they would turn them in. You didn't even have to really do that, because there were companies that were coming into Indianapolis to buy them from you every weekend. They would pay you anywhere from $2.75 to $3 an ounce. And so you didn't have to worry about, going to the Denver Mint, to pick up the coins or the actual bullion yourself. However, I have to share this with you. You're going to get a kick out of this. Being the typical redneck from Indiana that I was, and always interested in guns and stuff, I had well over 2,000 of these $1 certificates that I had kept. I had rotated more than $30,000 worth from my uncle's stash of money, and I had made a great deal of money. I mean, I really made a lot of money. $46,000 is what I made for that year. And that's when minimum wage was $1.10. And I said, why do I want to be a pharmacist when I can make this kind of money? And so I went on to graduate school and got into investing and whatever. But we did take the last $3,000 worth of cash, went to Denver to collect the things, and we were standing out there the night before. And there was a line of people, probably over 1,000 people, waiting to collect the silver. And everybody knew that everybody had a lot of cash on. Well, everybody was carrying a gun. It was really funny. When I go back and look at it, I realize how stupid it was. But it was exciting at the time. Then we drove back to Indiana, my buddy and I, and never did forget about it. So anyway, that was either here today, back in the old days. But keep a little silver on hand, folks. I think you're going to need it before it's all over. But, whether I'm right or not, it'll still be good. I've had this silver for, oh, man, it's been 40-some years now. No, it's been more than that. It's been 50 years now that I've had it. It's treated me well, so let's just keep in mind what's going to happen. We've gone up into the gap area in the IWM, which is the small cap. It certainly doesn't look very bearish here either. So unless this market, really collapses here, to me, it looks like we've still got a little bit more to go to the upside, maybe 4 or 5 more days to see if that's going to happen. It's going to be interesting, to say the least. We'll have to watch it very, very closely in here. But keep an eye on that VIX, because the VIX really will give you an indicator that fear has started to come into the market. But the old high we had back in, it was last July, was at 31. I think we will double that. We'll at least make 62 on this next run, which will be about a 61% retracement of the whole move from 2009, when the VIX got up to, I think it was got up to 106 or something. But that's what I think it will do, because there's just too much complacency in the market here in stocks. There's no fear at all. And I guess they shouldn't, because it keeps going up, but there's a lot of things, margin debt, all these things in historical terms have certainly, led the market to where you're supposed to be, and you want to keep an eye on that. If we take a look just a little bit about the Dow theory, which I still think is important, you'll see that, that the utilities stopped exactly where they should have on Friday. It made that really nice 135 pattern where you had the higher bottoms. That was that same pattern that we talked about earlier with about Bill and Roy Longstreet. That's very important. And then if we take a look at the transportations, which also look very, 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 they're down near the low of the year. They're trading actually under the lows that we made in March. That's another, really negative thing. So no matter what happens to this run here in the Dow Jones, we're most probably going to get a non-confirmation in the Dow theory signal. And believe me, that signal's been going on for a very, very long time, I believe since 1896. And that's going to be a really interesting thing to see happen if we do get this divergence. But when you watch CNBC and you watch Bloomberg and some of the other things, everybody's saying that doesn't mean anything anymore. Just like they do with the DAX, or excuse me, the VIX, when it's down at the levels where it's very, very cheap and nobody's paying attention to it. The next thing you look up and people are starting to, put on hedges because some fear is coming into the market. So this is going to be very interesting these next couple of weeks. It'll certainly be certainly be a lot of fun to watch, if nothing else. So we keep an eye very closely to that area right here. Now, I wanted to talk a little bit more about the bonds and the notes here, because there's a huge divergence because of that June contract in Treasury bonds. As you can see here, Treasury notes have gone up to the 786 retracement, whereas bonds, because of this June contract, see, the regular September, December bonds are not doing this. It's only the June contract that is making the area up in that 160 level. That's only because of the contract specifications that were put out by the Chicago Mercantile Exchange, and well, it was the Board of Trade at the time, and that's why the reasoning is why that is. It's before the delivery. It'll go right back to where it should be back in September, but September bonds have not gone above the 61% retracement of those old highs. So there's a big aberration there, and if you're not aware that that's happening, you can be confused, and you certainly don't want to do that. Now, the other one that I wanted to mention here, because I have a fondness of this, because my days at Drexel when Mike Milken was the junk bond king, you can see the ETF for the which is JNK for the junk bonds compared to the 30-year Treasury bonds. You know, there's been a very strong flight to quality here recently, and we've been in a very strong downtrend in junk bonds ever since last June. We've had 1, 2, 3, 4 lower highs now, and that's where I'm beginning to see that there is a problem in the debt market. It's not in the stock market, it's in the debt market, starting with junk bonds, then corporate bonds, then municipal bonds, and then finally the 30-year bonds and the 10 and 20-year notes. But what will happen is if these things start to break, people will move into the 30-year bonds and the notes just for protection. That's called a flight to quality. That's what usually happens. But if they all come down together, then that's when the real problem is really big, and that means that cash is king, and somebody's got a really bad debt problem that is going to affect the economy, very, very badly, even far worse than what's happened with long-term capital back in 1998, the firm that could never fail. And so that's, oh, by the way, we have one other line, ironclad investment. If you missed buying any shares in the Brooklyn Bridge, we found out today that John Corzine, formerly of governor of New Jersey, I guess, and also the former partner in Goldman Sachs, is coming out with his own hedge fund. So I imagine folks will be lining up for that. So we'll see how well that prescribes itself over the years. By the way, John Merriweather, who did run long-term capital, came back and had another hedge fund later after that one had complex. So that's just a perfect example. Just because one person fails at something doesn't mean they're good at it. It just means that particular thing that they didn't work. There's nothing wrong with that. I mean, hell, if they measured me, did I say hell? I guess I did. If they measured me by the number of times that I failed, the rulers would go around the world about 350 times, because it's not how many times you fail, it's how many times you pick yourself up, and get back in the game, and that's what you really want to do. Just don't lose all of your money. The first mistake is in being wrong. The second and most critical mistake is in staying wrong. And Roy Longstreet said, the first mistake teaches you, the second mistake kills. So remember the old Chinese adage, the smart man learns from his mistakes, the wise man learns from the mistakes of others. And that's one of the key things in learning, that I think if you'll do that, you'll be far, far better off than most of the other folks that are out there. If you have any questions, it's 877-927-6648. And we'll see what's happened. I got an interesting email this weekend from Priceline Charlie of La Paz, Mexico, and we were looking at the price of Priceline that I posted into the room. We did make that 61% retracement up there. It held so far, and I believe we're heading down to that 1050 level in Priceline sometime relatively soon would be my guess. So we have a question from one of our listeners about IPOs, initial price offerings. He asked if the numbers that we look at and patterns work with IPOs. They certainly do, but you've got to give them a few days to get themselves together and make sure that if you want to short, that there's availability of stock to short. Because if your firm that you trade through does not have the shares to short against it, then you're not going to be able to put on shorts. So we'll be able to take a look at this. Now we want to take another look at one of the other commodities that we follow quite often, and that is the crude oil market. And we have a real interesting ABCD pattern that is finally formed from our March 16th low that we made in oil down at 42.30 a barrel. Now we got up to the 1.27 expansion perfectly on Friday at 57.60. We went down to 55 and change, and then back to 57 again. So I believe that we're ready for a correction in the oil market that could take us easily down another 15%, down to the 49.50 area. And remember, this market has moved 25% off the bottom. And when it was making a bottom, if you remember, everybody was saying $30, $20 oil. And what did it do? It rallied 25%. So that's another example of trade what you see, not what you believe. So that's a really key indicator of what you're supposed to be looking at. We have one other request, and that is to take a look at natural gas, because I happen to be an expert in that area. I don't want to hear the sound of one hand clapping either, please. But we've had a pretty good bottom form, I believe, here in the natural gas contract. The problem is the big gap down and the wide range that we're having today. Because we did make the butterfly pattern down there at the 248 level. We got all the way up to 268. 20 cents in natural gas is a lot of money, folks. And now we've pulled back to below the 61% retracement, but we've done it in one day. And so you've got to be very, very careful here with natural gas, especially when you look at this big gap that we had. Gaps and wide ranges are two of the major danger signals with pattern recognition. You have to respect that stuff, because if you don't, you're looking at something really different. If we look at natural gas on a long-term basis here, you can see, the weekly pattern has taken us below the ABCD pattern that came in at the 260 level, and we're trading at 252 right now. So this is a really strong indication that this market is in a big downtrend, and you've got to be careful. So stick to the daily and hourly charts, and you'll be far better off than if you just try to not do anything other than do something really crazy with some of these things, because they do get a little wacko for sure. Okay, now someone asked me a question if I was a stockbroker. I am actually registered. Well, I used to be. I've let it expire. I've let my commodity license expire many years ago, and also my stock license. But I have five licenses across the board with the SEC, NFA, and CFTC that I've kept in. But the most thing that I'm happy about is that I've never had a complaint in the 48 years that I've actually been registered. So I feel pretty strongly of that. It makes me feel, that doesn't make it everybody's happy. It's just that no one's actually, made a formal complaint against me. And don't call in now. It's too late. I'm too late to fight those things. Okay. Okay, here's a question. Oh, about Apple. We've talked about Apple many times. Apple gets more press than any stock I've ever seen. It's constantly in the news. I mean, it is constant. They get the free advertising like I've never seen before. I went into the Apple store on Saturday just to see an Apple Watch. They had one of them there as a demo. I can't imagine anybody wanting to buy other than a novelty. I don't see this thing as being a big product, folks. But remember, I didn't think color TVs were very good either. Got to take a little break here. We got stocks still really strong, and we have silver and gold selling off, and so are Treasury bonds.
If you're like me, you see the world's emerging nations as a very real opportunity, as these countries and their economies are developing right before our eyes. And you can rest assured that Everbank has spotted this opportunity too. In fact, they just recently unveiled the new 5-year market-safe Future Economy CD. This is a CD that could really deliver, but you only have until May 7th to take advantage. Consider the facts. If the future economy's currencies beat the US dollar over the CD term, you'll get all the upside. And should they lose, no worries. There's zero downside risk here, as you still get back 100% of your deposited principal. Intrigued yet? The May 7th funding deadline is quickly approaching, so hurry over to everbank.com/TFNN-CD for more information, including important product details and disclosures. Once again, that's everbank.com/TFNN-CD. Everbank is an equal housing lender and member FDIC.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back, folks, and we were talking about the Apple Watches and, how they're making such a big splash. I don't know, but I have to tell you a funny story. You have to bear with me here because, I've been around a while, but 1956, they came out with transistor radios. I remember very vividly because they cost $50. Remember, the minimum wage at that time was about, I think it was 75 or 80 cents. So you can imagine something selling for $50. That would be equivalent. Minimum wage is roughly $10 now. and you'd be looking at $500 for a transistor radio. You could buy a car easily for $500 back in 1956. The World Series was going on with the Yankees, and we had a library where Sister Cotillo used to. I went to a Jesuit school, and one of the kids had a transistor radio, and we took an old book. I had nothing to do with this. They took an old book and hollowed it out, put the transistor radio on, and turned it on so the ball game could be going on when we were in the library. And Sister Cotillo was on her last legs, and she went literally bonkers trying to find this thing. She finally got so upset that the principal came in, and he penalized a whole bunch of us for doing it, but he still let us listen to the game. But that's how much those things cost back in those days, and they turned out to be pretty good. I was right about that. But color TVs and microwaves, I certainly missed that. Now, the long-term chart, I was talking a little bit about gold and silver because I want to do the gold-silver index here, and I want to do it on a long-term chart here. You'll see that the long-term chart on the gold-silver index hasn't really moved very much. We had a double bottom from 2008 where we did take those bottoms out from 2014. We still have a chance here, but the gold's got to hold above 1130. Just absolutely has to hold above that, in my opinion, and silver certainly has to hold above those old lows at $14 and 10 cents. They'll just go lower, and then gold will get down to maybe the 950, 850 level, and silver might go all the way back to $12, $13. We don't know where it could go per ounce, but these are the technical things that we're watching here. Frankly, if we do have a debt cycle problem that we're looking at, I believe gold and silver will finally move up. Back in the old days, if we had this type of environment, gold would be trading at probably closer to 3,000 than 1,200. But that's just my personal opinion, and that really doesn't count very much. So we're at a real critical level here, not only in stocks but in the gold market and also in the silver market also. We've had a collapse in crude oil too, folks. I mean, we've gone from $108 this year, all the way down to $42. So that can tell you that some of these commodities, have a long way to go to the downside. So pay attention to that, because that could be a sign of deflation. That's the one thing that the Federal Reserve cannot handle is deflation. Whether that's going to be a problem or not, remains to be seen, but it's something that we should focus on. I think I'm not going to be on the show Wednesday. I've got the old people's problem. I got to have a doctor's appointment, and doctors here in Tucson do not have a lot of flexibility with appointments. So I've got to keep that 9 o'clock appointment on Wednesday. But I'll be back on the show for Thursday. I'm going to try to either have Bill Ehrman or Bill Meridian as my guest next Monday, and to talk a little bit about the importance of these dates that we have coming up in just five short trading days. The currency markets are still, the dollar's still holding up near that 100 level. The euro's trading about 107 and change. So that's about it for today, folks. Live every day in an attitude of gratitude, and may God bless.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
You're watching Tiger TV.